G'day all, it's James Gerrish for Market Matters Weekly Update, and I'm joined by Peter O'Connor, who's Shaw and Partners, very well regarded senior resource analyst. For the second big interview of this week, Rocky, obviously it's not going to be as hard hitting as the one we saw the other night, but it may be as controversial. So we're here to talk all things gold, gold stocks, gold prices, where to from here in terms of gold stocks, and then I'm going to touch on a couple of the other commodity stocks that you like at this point in time at the back end of the recording. So, mate, thanks for joining us. It's been a while. We've spoken a few times in the past. Market Matters subscribers love hearing your thoughts, so welcome back.
Thanks, James. Good to be back. And yeah, what we've talked about in the past has kind of played out, broadly speaking, so happy to be here and happy to recap.
Absolutely. I'll pull you up on a couple of things that you've said in the past, because a lot has come to pass. So I'll start with setting the scene. So you cover, I think, 15 stocks. You've got you're the number one rated in BHP.
Yep.
You're the number one rated in terms of Aluka.
Yep.
You're the number one rated in terms of Whitehaven Coal, in terms of Bloomberg ratings.
Yep.
You've got you're number two in Oz Minerals. If I look at your peer group, so your returns over the past year have delivered above 40%. Your peer group's in the low 20s. So you've called it very, very well in the diversified resources space. Gold, in the last 6 months, has been a struggle.
Yep.
So 2 years ago, you were very bullish gold. That was a really good call. Last 6 months, not so much. The gold price has moved from above 2,000 an ounce to below 1,700 an ounce. What's the backdrop for gold prices at this point in time?
The gold thesis that we mapped out last year in May, and we did a lot of detailed work on gold and presentations and wrote quite a few notes about where we saw gold going. And I talked about a pathway or a trajectory. And I mapped out a view that gold would move higher over a period from 220 out through 223, 224. So I never mapped it out as a 1 quarter, 1 month, even a 2 quarter view. That said, I understand volatility in my sector, but the trend and the direction continues to be that gold price moves higher. You know why? The same factors that drove it back to that spike in August last year are still there. So 4 things drive gold price. Firstly, it's money supply, the amount of money that's going into the system. So last year, the key pivot was the 23rd of March. That's the day all markets bottomed. Why? Because Jerome Powell, the chairman of the Federal Reserve, said, "We will do whatever it takes." That was the key line. Amongst central banks globally, they all did this, that concerted effort to do the same. So money printing in the last 12 months has added 20 to 25% to global money supply in 1 year.
Subscribers will know the M2 money supply that we put in reports.
So think about that. That's a big change in 1 year. Okay, directionally that trend should be going up 3-5%, but 25% in 1 year, adding one quarter to 1/5. So that's the first driver, that money supply, and gold price correlates with that over time. So again, I give you that pathway view. That's where it's going. Secondly, it's interest rates. It's not the nominal rates that you see day to day that we see in the press. It's the real rate adjusted for inflation. And what we've seen of late is inflation starting to pick up, but nominal bond yields have rallied much higher. I think there's been a tactical short squeeze where the markets, hedge funds, traders, shorters have been trying to play the Fed and getting the Fed to do this Operation Twist where they wanted the Fed to step in and buy 10-year bonds. So 10-year yields have rallied much more than I would have expected. They've gotten at least 60 basis points this year. I don't think anybody would have picked that. So where my thesis has not played out in the last 6 has been the nominal yield.
So just in terms of bond yields, and to give listeners a flavour for that, when gold was at above 2,000 an ounce, a US 10-year bond yield was at 50 basis points, 0.5%.
Yeah.
Today, it's 1.54%. It came off 1.6% overnight. So there has been a huge stark change in the interest rate market.
And part of that is the nominal yield reflects inflation. That's what gold's all about, an inflation hedge. So directionally, again, that thematic is still right, but the nominal yield has gone at a much greater rate. Again, I think there's tactical overlays behind that than what inflation has. Inflation, as implied by yield curves, is now running about 2.2%. So if you subtract that from your 1.6%, you're getting a real negative yield of about 0.8. That was about 1% last year when gold price spiked. Looking ahead with that degree of money supply printing that we've talked about, the stimulus package that's about to come out from the US if it passes through the Senate and the Congress, we'll see inflation expectations pick up in the next 1, 3, 5 years. There is a base effect short term, but beyond that. So second driver is real rates. Real rates will head back towards negative 1%, if not more. Inflation won't stop at 2.2%. It's going a lot higher.
The genie's out of the, when the genie gets out of the bottle.
We could see inflation closer to 3% than 2.2. So that means real yields will go negative, and that's what drives gold. So that's the second driver. The third driver is ETF flow. Now, ETF flows, they're not a leader. I've got to be clear about this. They are coincident to gold price at best, but usually they're a lag. And what they do is they go euphoric at the top and they go super bearish at the bottom. So what we've seen is an ETF outflow over the last 4 weeks, which has been that bottom capitulation trade. So that to me was a good thing. We've seen that flush out. And everybody got exuberant last August and pushed the gold price too high. So pulling this all together, what does it mean? The yield curve today, based on all the stuff we talked about, money supply and yield curves and real rates, is suggesting the gold price should be $100 higher already. All things being equal, forgetting about where yields go from here. So gold price should be $1,800 today, if not $1,825. Then as the nominal yields come off in the States, and that's the narrative very much building overnight, that they did run too far, we should see that push higher. So our gold price deck has got a target price of into the mid-low $2,000 range, again over the next 2 years. That's still a plausible outcome. So take it as a minimum. The price direction is going to lead to a spike in price again. And it's not going to happen this quarter. It's going to happen in the next 1 or 2 years, but that's still out there.
So the key takeaway in terms of gold prices is they've obviously been weak, but now is the looks to be a capitulation style low. We've had a top in US bond yields. In our view, we wrote about this morning. It looks like we've had a low in gold price, and onwards and upwards for gold. Bullion as well as gold equities.
Well, gold equity is the levered way to play it, as you know. You can play ETFs or you can play via direct equity, which is even the more levered way to play.
So this brings me into what gold equities have done and your coverage. So you cover Evolution, Northern Star, Newcrest. You look at Newcrest, the biggest one in the sector. It's dropped from $38 at the high. It's trading around $24 today. Obviously, the leverage that's got relative to the gold price move has been pretty phenomenal. Obviously, an influence of the higher Aussie dollar has been playing into that as well. What's your take on Newcrest here?
Newcrest is the standout story in the sector, the unpriced, underloved, undervalued stock out there. So
is that just operational issues over years that have been the reason for that, or Lihir is just a complicated asset that the market doesn't like, or what's your take on or feeling for why it's been so unloved?
If you think about just the context of Australian mining sector, any company that ever disappoints, and think BHP, think Oz Minerals, Western Whitehaven Coal, anybody that's had an operational or a financial disappointment, it takes a long, long time to turn that around. Newcrest has had operating issues going back with Lihir, their major gold mine. Over a period of time, that's now largely addressed, and if anything, substantially behind them. And they've mapped out a profile on Lihir in terms of what it can produce over the next 1, 2, 3, 5 years, which is dramatically higher than market expectations. So the market is not valuing what Lihir will do going forward. Good management team, good balance sheet, good operations, bar some hiccups at Lihir. They've got to prove that. And again, Fortescue's in that same basket. And when they do, they get priced for that. And not only that, they've got a few growth projects which the market's just ignored. Why? Because they're going, they've got operating issues, don't need to be there. But they've got effectively half an Evolution company sitting next to their mine called Telfer in WA. Infrastructure, everything's ready to go, and they've got 3 million ounce resource today waiting to go. So there's a lot of unvalued property within, that's just one example in Newcrest. I like Newcrest. I think operational balance sheet, growth, etc., and the value is there. But in the short term, the key one is Northern Star. There's been some index plays around its inclusion in North American indexes called the GDX and the GDXJ. And because it's become a larger company post its merger with Saracen, which is a great thing, it's been upweighted in one index, but it's fallen out of the small index because it's too big.
So it's gone from $17 down to below 10, 980 I think it is on the market today. So that is obviously gold price related. Obviously when companies go through transformations, there are a change, a turnover at the register, and you're saying ETF flows as well? It's been index flows related to those two ETFs. That's specifically about the index weight in which they're in, and that's very much been post that merger. So it's not a reflection of the companies, it's just a reflection of how that index will rebalance. And it's rebalancing the end of this week and next week. So
that underperformance, it's the chronic underperformer in the gold space over that period of time we've talked about, and that's why largely.
But just so listeners understand, ETF when those do rebalance, they happen ahead of time. So traders get ahead of this. This isn't new news that this is happening. We're talking about it today. So traders are positioning ahead of this rebalance, as you made mention of. So Northern Star, plenty of upside from these current levels.
Yeah, again, a bit of context. So the gold equities last August were trading what I call the euphoric corner, the right-hand corner of my valuation versus share price performance chart. They're trading at probably 1.5 to 2 times price to value, and that was because the gold price is an all-time high. Now they're trading at 52-week lows and at a deep discount to their value. We've got stocks trading at 0.5 times their fair value. Northern Star's trading at 0.75 times. Newcrest is trading at 0.7 times. So they're cheap. So you need to look at companies not when they're at their 52-week high because you're 52 weeks too late. You need to buy them when they're getting close to the 52-week low. Yes, our call on that has been early over the last couple of months, but right now that formation of gold price backing plus the index inclusion issue with Northern Star gives you an opportunity in Northern Star. But as a group, they're clumped together almost exactly in the same area in terms of share price performance and value. So you could almost buy any gold stock today, and on the view I've just mapped out, you'll do well. The key pick, though, for me today is Northern Star. It's got the best growth profile over the next 1 through 5 years, which the market was valuing before, but now they're not. Newcrest has got a great story I've just mapped out, but it's not quite as cheap as Northern Star now. And there are other names, whether it's Golden Road or there's Regis or St Barbara, they're all looking cheap compared to where they were trading.
Evolution you cover as well, so that hasn't been as weak as the other gold stocks proportionally. It's dropped from say $6.60 down to about $4. What's your take there?
I like what I like what Evolution's doing and have done. So they're shown that they're the quiet company. They just do things and they do them well. Their most recent acquisition, they've bettered down. They've gone to net cash again, having funded that last year. And they've got a substantial amount of upside at their key operation in Australia called Cal, as well as the one they bought in North America called Red Chris. And that's going to deliver returns over the next 1 through 5 years. And I kind of like the fact the market didn't like their last result because they gave a reserve update which wasn't quite to the market's liking. But as they drill more and add into that, that will be a real upside for the company. So growth outlook, not quite as strong as Northern Star, but I think will be delivered into. Balance sheet's fine, and they've shown they can acquire and deliver and build and grow. So I like Evolution as well.
So just summarising the gold sector, we've got Newcrest, which has got the embedded value in the ground is probably the highest. You've got Northern Star, which has got has been sold down pretty aggressively. They've got a really strong growth pipeline coming forward, and Evolution has got a similarly strong growth pipeline.
Good summary.
All right, so we're bullish gold. We've written about it this morning. We've written about it in recent times, and it does come down to what interest rates, bond yields, etc., are doing. We think there's a key short-term top in terms of the US 10-year yield. I think over the next 12 months or so, it still does travel higher on the back of rising reflation expectations. But in the very short term, I think this trade has been overextended. Before I let you go, Pete, I just want to get your quick take on a couple of the other resource stocks. I was thinking back to a video we did, I think it was in 2019. I vividly remember it. You talked about Fortescue. If iron ore was around $100 a tonne, Fortescue is worth $23 a share, I think, at the time. It was pretty pie in the sky. I think the stock was trading $4 at the time. We've spoken about it a few times. We've spoken about BHP when it was 20, saying you mapped out a road to 40. It's now at 50. So what's your best pick at the moment? I know some of those have been overextended. Iron ore miners have been pretty hot recently. But a value pick in the space, what would be your pick here?
So the iron ore names still look extended, and last night's fall in price is probably going to contribute to that today. So I'm short the iron ore names because I just don't see the sustainability of the price beyond the next few months or quarter or two. So love Fortescue, love what they do, but I just think they've got headwinds coming with price, and that will be reflected in their share price. BHP and Rio, there's what I call the reflation trades. BHP, Rio, Oz Minerals, Aluka, South 32, even Sandfire now. They're in that reflation or rotation group, which has done really well. And they're all just recently trading their 52-week high. So a lot of that's been priced in, and they'll just move around based on this reflation or not reflation. The ones that have lagged, and not necessarily the public favourites, but it's Alumina Limited, Whitehaven Coal. So the energy group, but I cover Whitehaven Coal, but I broaden that to energy in general. but also Western Areas. Now, they're a bit of a quirk because they did an equity raise yesterday, but they look cheap. They've lagged their reflation trade peers. So I'd say coal, Western Areas in the nickel space, and also alumina in the alumina space have lagged that reflation trade, and they should be in that group. So if I was to pick the ones that I'm looking at that look value, have missed the trade, and should catch up, it'd be those three names. The other ones, you're really trading that momentum of the day-to-day reflation trade. And I like most of them, and I have no particular critique about any of them, other than that the iron ore names were correct. But no, I'd be picking Western Areas, Whitehaven / Coronado / Alumina Limited.
Pete, thanks very much for joining us. We'll get your take again soon.
Thanks, James. Great to be here.